My name is Darrell Godfrey, Chief Operating Officer for the New Jersey Redevelopment Authority. On behalf of our Board Chairwoman and Lieutenant Governor, Sheila Y. Oliver, and on behalf of our President and CEO, Leslie A. Anderson, welcome to our What's a Good Deal and When to Walk Away webinar. So let me give you a brief history of some statistics about the finances that we provide now in the New Jersey redevelopment marketplace. We were originally given $9 million. We used that $9 million to really fund two projects, our urban site acquisition program and our redevelopment investment fund. In addition to that, we were giving $10 million to do what's called Working in North Neighborhoods Fund. And that's to help the urban communities, not in the downtown north, but in the wards of the downtown north. But we have a slogan where we say, we're there first. And we're there first is really just about impact. We have approved up to $418 million in direct investments. We leveraged that up to $3.8 billion in total investments. And that is a tremendous, we did 266 projects, 15,000 in total housing units, and over 1,500 in jobs created. That is a tremendous effort from an institution that's only been in place for a little bit more than 20 years. But don't just look at us as just a funding, we also do bonding financing. Bonding financing is a critical step to helping companies that are undercapitalized really get into deals that they traditionally wouldn't get into. So what you can hear from me today is just really we have a tremendous amount of resources that can be used out there to help the urban marketplace. If you need additional information, please go to our website, njra.us, njra.us, and you will see contact information. You can either contact me, Darrell Godfrey, you can contact our CEO, website Leslie A. Anderson, or any other numbers that are there. Thank you and have an enjoyable webinar.
Coast. George Vallone has compiled extensive experience in urban housing through a socially conscious approach to development. Hoboken Brownfield Company is now 1/3 complete on its most innovative project yet, the redevelopment of a 15-acre brownfield site at the northern edge of downtown Jersey City into a new mixed-use, transit-oriented neighborhood containing over 1,800 apartments. This mixed-use project continues the transformation of a contaminated post-industrial wasteland into a vibrant new neighborhood with shopping, dining, entertainment venues, and over 3 acres of public parks connected to the 2nd Street station of the Hudson Bergen Light Rail train with a $4.6 million rail-to-trail bike path. Very impressive. Mr. Vallone is past president of the New Jersey Builders Association and a founder and first chairman of the Builders Association Mixed Use Developers Affiliate, the members of which are responsible for the construction of more than 75% of all rental housing built in New Jersey. Since 2015, George has served as co-chair of the Green Infrastructure Task Force, a partnership between the Builders Association and New Jersey Future, a nonprofit organization that focuses on smart growth principles and environmental public policy issues. His leadership created the Developer's Guide to Green Infrastructure, which has received national attention and has been adopted by New Jersey DEP as their best management practices guide on how to use green infrastructure for storm water management. Also, he's the past chairman of the Strategic Planning Committee of the Capital Markets Partnership, where he helped negotiate a partnership with the U.S. Green Building Council to deploy standards to certify the level of resilient standard design for buildings, infrastructure, and communities, which launched internationally to decrease the risk of damage from extreme climate change related weather events. Mr. Malone is a sought-after lecturer and possesses an MBA in International Finance from Fordham University. He's also one of the first developers to be invited to become a member of the Council of Real Estate. Without further ado, I'd like to pass it over to our presenter today, Mr. George Vallone.
So, well, welcome everybody. It's good to be back. I've been doing training for the NJRA for got to be close to 20 years, but these last couple of years with COVID and the lockdowns and everything, it was curtailed, and now we're back, but now we're doing it on Zoom. So I look forward to hopefully not in the too distant future, we can reconvene face to face in a classroom type setting, which we used to do down in Trenton. So I was asked to speak about, you know, what is a good deal and when is it time to walk away? So in order to really, here's the simple answer. If you can't make any money, walk away. Okay, so anybody that wants to leave now and go out to lunch, you got the whole lesson. No, I'm just teasing. Basically, it really went, in order to know if it's a good deal, you have to go through a fairly extensive risk management process, because the role of the developer is to bridge the expectations of the community that you're working in and the expectations of your investors, who are going to provide the majority of the capital that's needed to do the redevelopment. So the way you do that, the way you create that bridge between community expectations and the capital provider expectations is by information, by gathering information. And we're going to talk about how you gather information in the major risk category areas, how you gather information, how you quantify the information, and how you reduce or hopefully eliminate the risks that that information informs you about. So I think we should dive right into the PowerPoint I prepared. We'll walk through that together. There'll be a break about halfway through. This is a 90-minute session. I want to make sure we have plenty of time for Q&A. If there is a question that applies to a particular area that I'm speaking about at that moment, by all means, put it into the chat room, and Venitra is going to give me a heads up on it and read the question, and then I'll do my best to answer it as quickly and as thoroughly as I can, and then we'll proceed. There will be time at the end for Q&A too, so if you want to absorb the whole thing and then see what questions remain, that's fine too. You can put those questions in as we get near the end of the presentation. So without further ado, let me go to the share screen button, and then the PowerPoint. And I gotta cut the extra stuff out like that. There we go. So I'm assuming you can see the screen, and if not, put it in the chat room, and Venitra will tell me I messed something up, but I don't think I did, because we practiced about an hour ago. We should be good. So as I mentioned, what's a good deal? A good deal is when you can make money for yourself and you can make money for your investors, such that they're going to want to invest with you again. Anybody that's in business for themselves knows that the cheapest way to acquire business is to have repeat business, because you've already sold the person on the good or the service that you're selling, and they had a good experience, and they're going to want to do that again. So that's the definition of a good deal. When you walk away, it's the opposite. If you either cannot meet the expectations of the community, or you cannot meet the expectations of your investor, if you cannot create that bridge, you're probably not going to be able to do the deal. And if you try to force it, it's probably not going to end up being a good deal. And the worst thing you want to do is disappoint people. If you disappoint a community and you don't deal transparently, in good faith, and so that they recognize as you go through the risk management process what those risks are, whether or not there's a role for them to play to reduce or eliminate those risks. If you don't do any of that, you just do everything behind closed doors, and you show up on day one and you walk away 6 months later, that's not going to leave a good taste in the community's mouth. You really need to be transparent with your host community. You need them to understand the risk management process you're going through. You need to make suggestions as to how they can help reduce risk. And that's that way, at least if you do have to walk away in 6 months or a year, they're going to fully understand what the challenge was and why they couldn't overcome it. And maybe that'll inform them on some future activity they can undertake to set the table for a successful deal next time around. So that's the overview. So what we're going to do today is we're going to understand risk. We're going to understand how risk management is undertaken and how it affects the cost of capital at all layers of the capital stack. The equity layers, which is the investors. There's a mezzanine layer, which is a type of debt that looks like debt but acts like equity. We're going to talk about senior financing, junior financing, and then we're going to get into, toward the end, we're going to get into some creative financing strategies. When you're working with a seller, and you can structure joint ventures, or you can structure seller financing in a number of different ways that help to finance the deal and reduce risk. Contact info. This is a sad day. We're moving out of Jersey City after 41 years in Hudson County, 25 years in Hoboken, 15 years in Jersey City. We are now moving out of Jersey City. Construction is beginning on the last 3 phases of that 1,800 unit redevelopment we're doing at the north end of downtown Jersey City that Craig spoke about. And so we are pulling off the sites. Our offices have been there since we started assembling that property back in 2005. And here we are in 2022. 1/3 of it is built, 3 buildings, 637 units is built. And now we're starting on the remaining 3 blocks, which is another 1,200 units. Round numbers, 1,200 units. It's actually a little over a total of 1,800 units, closer to 1,900 units. And that's going to be breaking ground late this year or early next year. So before we talk about risk, what does a risk-free investment look like? Because obviously investors have the opportunity to put their money into any kind of investment product that they want. And so they are always looking at, if I put my money into investment A, what's the risk and what's the reward? Or if I put it into B, what's the risk or what's the reward? They're always looking at alternative investment scenarios where they can decide whether or not the risk is worth the premium. Because obviously riskier deals come with more return as a direct relationship between risk and reward. So the benchmark of zero risk investing is US Treasury bonds. That's the gold standard in investing. If you don't care too much about the return your money's making, but you're all about preservation of capital, then you invest in T-bills. You buy US Treasury bonds, referred to as T-bills, because you are absolutely guaranteed you're going to get back all the money you put in and whatever the interest rate is that happens to go along with that particular bond. And the interest rates change depending upon the duration of the bonds, but it's not much. So I looked them up today, and here are the T-bill rates as of today. So if you buy a T-bill, essentially what we're doing is you're loaning the United States government your money. And in the case of a 1-month bill, you're loaning it to them for 30 days or for 1 month. You are getting just slightly over 0.5%, 0.58% is going to be the interest rate annualized on a 1-month T-bill. And that slowly goes up as the duration of the T-bill goes up. So for 3 months, you get a little over 1%. 6 months, you're at 1.5%, a little over. 1 year, a little over 2%. You got to go out to 5 years to get you to 2.7%. And with inflation running right now about 2.5%, 3%, you really need to go all the way out to a 5-year buy just to be able to offset the erosion of value that inflation inflicts on the investment. 10 years, you're at 2 3/4, and to get over a 3% return, annual return, you have to buy and commit to loan your money to the government for 20 years. So interest rate risk, financial risk on Treasury bonds is zero. There is no risk, but what you give up for the confidence that you're going to always get repaid is you give up the return. You're not getting a very significant return. And there are a lot of people out there, particularly sovereign wealth funds, very high net worth families, you know, they probably put half or more of their money into these kinds of investments where they are guaranteed that the principal will be repaid at the term. So in real estate, which is a higher risk and higher reward investment vehicle, there's three ways that we make money in real estate as a developer. So first thing is negotiation. And in my world, everything's negotiated. The land purchase price can be negotiated. It can be negotiated in terms of dollars, or it could be negotiated in terms of what kinds of conditions you can put in to reduce risk. What kind of contingencies can you put into a purchase contract with a land seller to reduce risk? So we're going to talk about a bunch of those things that you can do to negotiate with the seller. I mean, my general negotiating opening with a seller is, look, I can give you your asking price, or I can try really hard to give you your asking price, but you have to give me time to be able to measure and reduce risk, whether or not your sale price is really a sale price that I can work with. So I'll give you your price, but you got to give me my terms. Appreciation is the obvious way you make money. You improve property. You can do that through soft money expenditures, obtaining approvals, getting clearances, getting tax abatements and pilots. You can do all those, what I call soft improvements, definitely increase the value of property. And of course, hard improvements, which is building buildings, is the other way to do it. And typically you do both when you're a developer. You get a bunch of approvals and you get permits and pilots and things. Payments in lieu of taxes is a pilot. You get those things while you're going through the soft cost part, getting your zoning entitlements, getting through your environmental risk entitlement track. And we're going to talk about all those kinds of soft improvements, as well as how to manage and de-risk the hard costs of the project. And the last way you make money in real estate is by planning for your tax situation. So in general, capital gains taxes at the moment are 20%, and ordinary income taxes at the highest level are 39%. That's the federal rate. New Jersey makes no distinction between capital gains income and ordinary income. The maximum rate is about 7.8%. So you don't get any break on structuring your income as a capital gain versus ordinary gain from the state of New Jersey, but from the federal government, the 19% difference. If you can characterize the income you make on a deal as capital gains income, which means longer than 1 year, generally, that's the definition. There are some other nuances to capital gains characterization of income, but generally speaking, if you hold an asset for longer than a year and then sell it, that's a capital gain. You get taxed at 20%. If you sell it for under a year, you're going to be up at 38+%. So 19% improvement in the bottom line amount of cash you get to take home after taxes if you can plan your taxes to get that income characterized as capital gains income. So what's the risk process all about? Managing risk is about identifying risk, quantifying what the risk is, and either eliminating it or at least reducing it to a manageable level. That's what risk management is all about. And we're going to spend some time talking about risk management right now. So there are 5 major risk categories in brownfield redevelopment. You got financial risk, entitlement risk, environmental risk, construction risk, and market risk. In greenfield redevelopment, you go down to 4. You eliminate environmental risk because presumably greenfields don't need to go through an environmental risk management process. There's probably some limited environmental due diligence you want to do, even if you believe you're developing a greenfield site. And we'll talk about that when we get into the environmental risk track here today. But generally, if you're in a greenfield, meaning there was no industrial activity on the property throughout recorded history. In this country, they started recording history about 200 years ago. A company called Sanborn started making maps of urban areas because insurance companies wanted to know what was on the property and what was the use of the property, so the insurance companies could underwrite and insure those properties. So Sanborn started doing these maps a couple hundred years ago. I think it was the early 1800s. And you can go back and look at a piece of property on those Sanborn maps and determine whether or not there was ever any type of industrial operation that may have had environmental impacts. But we'll speak more about environmental risk when we get to that part. So since all of the four categories, the non-financial categories, are impacting the financial risk, we're going to talk about those four. So entitlement risk is really all about zoning. Entitlement means, what is the property entitled to be? What is the as of right zoning? If you intend to build an apartment building, then you want to make sure that the property that you intend on buying has zoning for apartment buildings. And if not, you have to work with the community and work with the town and try to get that zoning put in place. So local knowledge, essentially, it's like a two-step process to see what a property is zoned for. If you go into a municipality anywhere in New Jersey, you want to go into the clerk's office and you want to buy the zoning map and you want to buy the zoning code. The zoning map, you look up your property on the map, it'll tell you what zone it's in, and then you go to the zoning code, you look up that zoning type, that zoning area, and then you'll see exactly what you're permitted to do and all the standards like setbacks and height and density. That's how you gain local knowledge of whether or not your property is entitled for its intended use. If it's entitled for your intended use, you've just dramatically reduced zoning risk. You're not 100% there, but you've reduced it a lot. Because unfortunately in New Jersey, even if you go to a planning board to get an approval for a property with a use that's already entitled, it's already zoned for, there still can be appeal risk. Somebody that doesn't like you or doesn't like your project can still sue the planning board and try to overturn that approval. In other states, like New York State, for example, you don't have that problem. If you go in with a set of plans for a piece of property that's zoned for exactly what you're going to build, they just do a compliance review and they check your drawings and they make sure that everything that you're intending to draw on those drawings is permitted under the code. And if it is, they write a letter of zoning compliance and you take that and your plans right to the building department and you pull your building permits. Unfortunately, in New Jersey, they don't do it that way. Even if you have a fully compliant application to a planning board and they give you the approval, within 45 days of that approval being memorialized, anybody can still appeal the approval. So there is some risk, even with an as of right, but for reasons I'll get into in a couple of minutes, the risk is much, much lower. Political relationships, super helpful. If you go into a community and you're the first time there and nobody knows you, it would be very helpful to try to get introductions from politicians that you know to the local politicians in the community you're wanting to develop in, and go meet them and introduce yourself and show your track record and ask the local political leaders to introduce you to community stakeholders, because you really want to meet the neighbors immediately around the development site. You want to meet if there's any type of a community or a ward committee or an oversight committee. You want to meet those people as early as possible and talk about what you're intending to do and gauge their reaction. I mean, you may have a fully compliant application to build a building that's completely permitted by the current zoning law, but if the neighbors don't like it, you better do something about that to get them to like it. Find out what kinds of benefits or amenities they'd like to see in their neighborhood. What can this project deliver to the community that makes it worthy of their support? Subject to.
I have a question in the chat.
Go ahead, Benitra.
The question asks, do you rezone ever?
Yes, I prefer to rezone a property when it does not have the zoning that I'm intending, for my intended use. I always try to get it rezoned. So there's two ways to get approvals. Every community has a planning board, and you go to the planning board when you have a application for a compliant project, something that fully complies with the law. That's planning board. All they're supposed to do is look it over, make sure it complies, and vote yes for the approval. If you don't have the zoning you want, you have to go to the zoning board of adjustment. So if you want to build an apartment building and it's zoned industrial, you need the zoning board of adjustment to change or adjust the zoning from industrial and on your property to permit you to do residential, to do a apartment building or a condo building. That has a higher risk, and we'll talk about why. It all has to do with appeal risk. I'm going to talk about that in a minute. So you can get, if you sign a contract that is subject to getting your zoning approvals, then you've reduced risk a lot. If you don't get the approval, you don't have to close. You walk away. All you lost was your out-of-pocket costs to try to get the zoning approvals, which is a lot better than putting down a great big non-refundable deposit. And then when you don't get the approvals, it doesn't matter. The seller takes your deposit and close. If you have a subject to zoning approval, or what we call contingent on zoning approval contract, and you don't get the zoning approval, you get your deposit back and you walk away. So community consensus building is really the key. If you give the people what they want, they're going to be very, very unlikely they're going to try to appeal your approval. If they see that your project is going to bring direct benefits to their neighborhood, they're going to be in favor of it, and they're going to either show up at the planning board hearing or zoning board hearing, as the case may be, and they're going to speak in favor of the project, or equally good, they just don't show up at all. If you have an application and nobody shows up, nobody asks questions, nobody objects, and the planning board is favorably disposed to grant you the approval, then they'll grant you the approval, and it's much quicker, and you're out of there in a matter of an hour or two. So here's the thing with appeal risk. So if you go to a planning board where you have an as of right zoning application because the ordinance, the zoning ordinance had been adopted by the city council, or they've established a redevelopment area, which is also established by the city council, you've got the as of right for that approval. When you go to the zoning board, that means you don't have an as of right. You're going to go for use change or major variances like height, density. You're in front of the zoning board. So here's the process. And this goes for both zoning boards and planning boards. If you make your application and there's no objectors, or if there is, at the end of the presentation, the board votes. If they vote in approval, then the lawyers get together and they write a memorializing resolution, which basically spells out, it's a summary of the presentation you made, and it recites the vote. The board vote is on one of the last pages of the resolution. It shows how many board members there were and who voted yes and who voted no. That memorializing resolution then gets approved at the next board meeting, and then it gets published in the newspaper, the local newspaper. That usually takes a couple days to get the resolution into the papers. They have those public notice sections that hardly anybody reads, but it has to be in there. And then starting on the day of publication, for 45 more days, anybody that has standing can appeal that approval. And on day 46, if nobody appeals it, your approval is vested and you have eliminated zoning risk. You have a fully vested site plan approval from either a planning board if it was conforming, or a zoning board of adjustment if it needed variances or use changes. And you are now zero zoning risk. There's nobody that can appeal that after 45 days. So if they do appeal, here's the benefit of being in front of a planning board. The planning board is presumed to be right because all they're doing is they're sort of doing that same kind of compliance checking that New York does with an individual zoning officer. Here, the planning board needs to be convinced that you completely meet the code. And if you do, and then somebody appeals it, the burden of proof to prove that you didn't comply with the code is on the person who's appealing it. The appellant has to convince the judge that the planning board missed something, there was something going on nefarious, or whatever the various reasons they use. The lawyers are good at coming up with lots of reasons so that if one or two doesn't work, he's got other ones, and hopefully one of them will work. You only need one good reason to get a planning board approval overturned by a court. But the proof of burden is on the person appealing you. Now, if you have a zoning board approval, it's the opposite. The zoning board, the presumption is that they were wrong, that the developer didn't deserve the approval, and now the developer has to prove, has to basically represent his whole case that he presented to the zoning board, why he deserves a change of use or a change in the standards. And now he's got to make that same presentation to the judge. So the burden of proof is on the developer. So for all those reasons, it's much better to either have a zoning ordinance put in place that gives you what you want, or have the city set up a redevelopment area, which gives you the right to do your zoning on a customized basis. It also gives you the right for long-term tax relief through either abatements or pilots. And there are other benefits that come with redevelopment area zoning, which is my preferred way to go into a town and go through the zoning risk process. I prefer to have redevelopment area established and be designated as the developer and work with the town on what the standards should be, what kind of height is appropriate, what kind of lot coverage, what types of setbacks are all appropriate. And then they write that into the redevelopment plan, and you go to the planning board for your approval. For those of you that are interested in doing a deeper dive on the zoning process, I learned at our practice session an hour or two ago that on June 23rd, NGRA is going to have their next class, which is going to be a deeper dive into zoning. It's going to be called Zoning and Land Use Law. And you're going to have a planner, Kristen Russell, and you're going to have an attorney, Mike Semeraro, who does zoning work. You're going to have an attorney and a planner as the lecturers on that next presentation by NJRA on June 23rd. So those of you that want to deeper dive into this particular zoning risk track should probably sign up for the June 23rd seminar. So let's go into environmental risk process. And by the way, this is the order I do things too. When I do risk management, I start with entitlement risk, and I want to make sure that I either have the zoning I need or I don't, because if I don't have the zoning I need and I can't get the zoning I need, there's really no reason to do anything else. That's the first time when you just say, okay, we're walking away. We do not have zoning that permits what we want to do. And if we want to go, I mean, you can go to the zoning board of adjustment and ask to have that zoning changed for what you want to do, but you have to be willing to do a lot of community homework to make sure that nobody appeals that approval. So once I'm sufficiently comfortable that entitlement risk is under control or eliminated, then we go into environmental risk. So the first thing you do in environmental risk is you do your due diligence. There's 3 levels of due diligence that each level you go through gives you increasing certainty as to what the environmental risk is. So the first one is basically just a history study. You go back, you look at those Sanborn maps, you see whether or not there was ever any industrial operations on the property, and if there were, what kind of industrial operations? Were they the kind of industrial operations that typically contaminated either the building or the soil or the groundwater or all 3? That's going to inform you whether or not you need to go further into the due diligence process. If you do, you go to what's called a phase 2. And here you do invasive testing. You go into the buildings, you test things, you test the floor, you look at the old light fixtures. Some of these mercury halide lamps are still there. Mercury being a highly contaminated product. You do some soil testing, you bore down, you pull soil samples out of the ground, you do water testing, you go down deeper into the water table, you test the water, you see whether or not any of the impacts that were in the buildings got out and impacted the soil, and whether any of the impacts to the soil is impacting the groundwater. Based on those results, you can start to estimate what the remedial action work is going to be. What kind of a work plan are we going to need to get that approved? If you still are in a mode where you feel that what you've learned thus far doesn't look like it's going to kill the deal, and you want to go further now into environmental risk management, you then hire an LSRP. Back in 2012, the DEP began licensing site remediation professionals. So an LSRP is a licensed site remediation professional. And LSRPs, starting in 2012, began to do oversight of brownfield remediation projects, which previous to 2012, was handled strictly by case managers in the DEP. And the case managers, you know, generally good guys, generally trying to do the right thing, but very overworked. Back in 2012, there were over 20,000 known brownfield sites in New Jersey, and you had about 150 case managers. So you can imagine how many cases each one of those managers had to manage. And it was a very slow process. So starting in 2012, you were able to hire a site remediation professional licensed by the DEP, and you can have him take you through the remediation process. And remediation process to get to finality is several steps. You do your preliminary assessment, which is also called an environmental site assessment. If you did your phase 1 and your phase 2, you've got most of the information already to get to your phase 3 remedial action preliminary assessment. You then go ahead and do a more robust site investigation. If the preliminary assessment indicates that there could be widespread contamination across the site, you're going to have to do a widespread site investigation. When the site investigation is complete, you now know what you have in the buildings, the soil, the groundwater, and now you can start to write your remedial investigation report, which includes the recommendation. It's basically called a RASR. The DEP loves acronyms. Remedial Action Selection Report. So your LSRP will come up with a range of remediation protocols, all the way from digging every single molecule of contaminated soil out of there and pumping and treating the groundwater till it's pristine. That's generally too expensive on one end of the spectrum. On the other end of the spectrum, you could leave certain contaminants on site in the soil, as long as you cap the soil, and as long as the soil is not impacting the groundwater. So the regulatory environment in terms of brownfield remediation is basically protection of two things: the public, the people that live on top of that brownfield site, and protect the groundwater, the water that's underneath the site. As long as you come up with a remedial action selection that does those two things, protects the public and protects the groundwater, you're probably okay. And you'll get your RAO, which is the end game. So when you're done with the remediation, your LSRP writes a remedial action report, which reports on all the work that was done from the beginning through to completion of the cleanup. And then he issues the remedial action outcome letter, which is that's the new standard for what used to be called a no further action letter, an NFA. When it was under case management oversight by the DEP, they issued a no further action letter. I love the sound of a no further action letter. And in 2012, when they decided they're going to now rename no further action letters remedial action outcome letters, a lot of us in the regulated community were not super happy with that, but you know, they assured us it's the same thing. We're just calling it something different. It means the remediation is complete and you've got certain liability protections in place now. Those liability protections are extremely important to a brownfield developer because it's two things you get. You get reopener protection. So if the DEP decides, 5 years after you're all finished, that one of the standards for one of the contaminants in your property just got a lot stricter, they can't make you go back and reopen the case and now re-remediate the property to this lower standard. They cannot do a reopener once you're done. You got your RAO, you followed all the rules that were in place at the time you did the remediation, you're done. And the other protection you get is third-party liability protection. So if anybody that's living on the property or nearby the property makes a claim that they somehow got sick because of your property, they cannot sue you because you did everything you were supposed to do under the law in place at the time you did the remediation, and that voids third-party liability. So very important process to go through because it sets the table for the kind of property you want to use. If you build industrial, it's easier, it's less stringent. If you want to go all the way to residential, it's a lot more stringent. So depending upon your use, you can calibrate what your remediation work plan is going to be. And then you have a bunch of remediation contractors that take your work plan and give you bids on it. And you've now identified, quantified, and you've eliminated the environmental risk to the extent that you now know what it's going to cost you to clean up your property so you can build your project. Other environmental risk management techniques is, again, like zoning contingencies in your land purchase and sale agreement, PSA, you can put environmental contingencies into your land purchase agreement. You've got to do your environmental due diligence. You've got to get your remedial action work plan approval. There can be cost limits. You can negotiate that the seller is going to share some of those costs. So all those 4 items there under the subject to contingency language are things you can negotiate into your purchase contract with your land seller, all of which give you less risk. There are reimbursement programs. There's brownfield reimbursement programs where on commercial properties, you can get up to 75% of your brownfield remediation costs reimbursed to you. On residential, it's 50% of your costs. But that's a back end incentive. So what they do is the way they figure out the reimbursement is they figure out there's about 4 or 5 different kinds of taxes that properties pay to the state. And they will calculate how much of those taxes you paid before you did your redevelopment and how much taxes you're going to pay after your redevelopment. And they will reimburse you the difference between the two, the pre-development tax income to the state and the post-development tax income to the state. And they will reimburse you the difference between those two until you've reached that threshold. Like I said, until you've reached the 50% of what you spent cleaning up a site if it's residential, and then they'll give you up to 75% of what you spent cleaning up the property if it's commercial. And finally, the other hedge you can use is there's insurance that you can get that will reduce environmental risk. The most popular one, and the one that's still available widespread in the market, is PLL, Pollution Legal Liability. And that basically insures you against unknown risks. So when you do your site investigation and you do your remedial action work plan, that addresses all the known risks. Your LSRP says, here's what we need to do to clean up everything we discovered in the buildings, the soil, the groundwater. Those are the known risks. And so you're going to have a budget for that. You're going to bid that out like we talked about a minute ago. But there's also the potential for unknown risk. If you have a very large site and you're doing 1 soil sample for every 1/4 acre, it's entirely possible you may have missed what they refer to as a hot spot. Somebody may have dug a hole in the ground, dumped a 55-gallon drum of some type of toxic chemical into the hole, and it pretty much stayed in that area. And when you did your site investigation, you missed it inadvertently, you missed it. And now you're digging up the whole site, you're taking out all the contaminated soil that you discovered and delineated during your site investigation, and all of a sudden you hit some ooey gooey liquid that looks and smells terrible. And then you sample that and you discover that that's something bad that now has to be removed. All those costs of remediating that unknown risk that you discovered during the process of remediating the known risks, the PLL insurance policy kicks in and covers you on that. It's relatively inexpensive coverage too. They underwrite the cost of that insurance policy based a lot on how thorough your site investigation was. So when you apply for PLL insurance, they ask you for a copy of all your environmental documents, your assessment documents, your site investigation, your selection report, everything that you've got before you go in the ground and start cleaning up the property. They want to review all that. And if you did a super thorough job, you can pick up $5 million of PLL insurance for $250,000, which is cheap when you think about the potential costs if you discover something unknown. We had a Superfund site we were remediating in Jersey City, and it turns out that it was a barrel and drum recycling business for the last 75 years. And those are notoriously contaminating operations, because typically what they did is they took 55-gallon drums of bad stuff, dumped it out behind the building, and then sandblasted and repainted the barrel and gave it back to you. So you got a nice brand new 55-gallon drum back, and they just ditched 55 gallons worth of some contaminated material in a hole in the back of the property. So these are operations that have been going on for a long, long time. And most, if not all, of those barrel and drum refurbishing businesses that operated way back when were horrible polluters of the property. A lot of them were run by the mob and bad people, and they were using it as toxic waste dumps. So unfortunately, well, it wasn't unfortunately, because we did have the proper insurance, but we did one of those deals on an 1.5 acre site in Jersey City where there was a barrel and drum operation. We estimated it was going to cost about $1 million to clean up the property, but we bought a PLL policy with a $3 million umbrella layer. Halfway through digging out the contaminated soil, we discovered that somebody, probably 50 years ago, based on how deep it was in the property, somebody had dumped a drum of phosphorus, white phosphorus, under that ground and then buried it over decades of fill. And white phosphorus is a highly contaminated subject. As soon as the excavator pulled the dirt off the top of that, it ignites spontaneously when it's exposed to the air. That ended up costing us a little over $3 million to clean up that unknown risk. But the environmental PLL insurance policy picked up $3 million of it. I think it cost us about $500,000 on top of that. We should have had a $5 million policy, but certainly the $3 million policy got us most of the way there and saved us from what could have been a significant environmental cost overrun. And finally, under environmental insurance, there was a fairly available insurance policy called a cost cap policy. Now there's only 1 or 2 insurance companies that offer cost cap, and it's very expensive. Cost cap covers the known risk. So whatever you decided you had to clean up under your remedial action work plan, you could get a cost cap that says, okay, you're gonna, let's say it's a $10 million cleanup, there'll be a $1 million deductible. So the cost cap would kick in if the cleanup went over 11 million. Very expensive insurance. Most developers that I know would rather do a very thorough site investigation so that there are the known risks are really, really known. You're not likely to miss anything, and then backstop that with a PLL policy that covers whatever unknown risks remain. So doing environmental due diligence can reduce risk and save money. We talked about a lot of that already. If you do turn up during your site investigation that there's a much worse environmental problem than you or the seller of the property knew about or was willing to admit, you can renegotiate the price. You can integrate your due diligence for environmental work with your geotechnical. If you're going to be drilling down into the soil 100 times to figure out whether or not the soil is contaminated, you could also drill at the same time and figure out what your geotechnical needs are going to be, meaning what type of structural system is going to be needed given the geotechnical characteristics of the land you want to build on. Is this going to be piles to hold up the building? Are you going to be able to do spread footings to hold up the building? Can you do a pressure slab? You know, those types of structural costs can be reduced if you do that geotechnical investigation at the same time you're doing your environmental investigation. We talked about liability protections. We talked about unknown risks and how to hedge that with PLL policy. And going through that risk management process enhances the likelihood that the transaction is going to close, because you're going to be working with the seller and you're going to be disclosing everything that you've discovered, and he's going to probably be able to figure out, along with your help, whether or not the purchase price that he was expecting to get for the property is still fair, or if it needs to be reduced because there's a lot of environmental costs involved with being able to, before you can develop the property. So we then move, once we know that the property is entitled and it has the zoning for our intended use, and we've gone through environmental risk management, and we know that the environmental impacts on the property are manageable and we've got a budget for that, we then go into construction risk. Now, we had our own construction company for 25 years. So we're fairly, and was all focused on Hoboken and Jersey City. So we're fairly good at estimating what construction costs are going to be in that marketplace. But you still, and we did this too, even though we knew pretty much what the conditions were, what the hard costs of construction were in Hudson County, we still used to hire a very experienced construction manager to oversee the design team. So the design team is your architect, your engineer, your mechanical, electrical, plumbing contractors, your structural engineer, not contractors, designers, and then your structural engineers. They're designing the building, but as they go through each step of the design process, and we're going to talk about what the design process is in just a minute, as your design team is working through that design process, your construction manager is reviewing those plans from a cost standpoint. If I know based on my construction budget and my development budget that I can only spend, pick a number, $250 a square foot for hard costs, my design team better be designing a building that can be built for $250 a square foot. And that's where the construction manager comes in, because he's constantly monitoring the designs vis-a-vis what it's going to cost to build that design. So once you have your design development, and he's doing value engineering too. He's saying, look, we can't afford to have balconies that protrude from every apartment, but we can recess a balcony area and create a little bit of outdoor space without having to extend the slab out beyond the edge of the building. The more times the building undulates, which means the facade goes in and out, the more expensive that costs. So that's called value engineering. If he sees that the design team really thinks it would be valuable to have balconies, he's going to tell them the least costly way to build the balcony, which is a recessed balcony, as opposed to an extended balcony. And by doing design development with the value engineering process all throughout it, you've got budget certainty. You now know that the design of the building that you're going to take to the planning board or maybe the zoning board of adjustment can be built for $250 a square foot. And then the final way that you can hedge your construction risk is to get it bid. Take that contract, take those designs and go out to bid with a couple of capable contractors and ask for a GMP, which is a guaranteed max price contract with a completion guarantee. And that generally should be bonded. So basically, you've now got a capable bonded general contractor telling you it's going to cost $250 a square foot and I'm going to be finished in 18 months. And if it doesn't cost $250 a square foot, he's on the hook for the increase. And if he can't get it done in 18 months, he's going to have to pay you some penalty to offset the cost to the developer of having to carry that construction phase longer than he anticipated. The longer the construction takes, the longer it is till revenue starts coming in. So that's generally how we manage construction risk. And the design process, where you're going to have your construction manager watching how this is evolving, how these designs are evolving. It comes in basically 4 parts. So your conceptual design, you're at about 10% done. And he can do a back of the napkin type of envelope and say, okay, for that type of building, that type of concept, we're probably looking at a building that's going to cost about $250 a square foot. He then checks with the developer. Are you guys okay with $250 a square foot? No, we're not in a market that can support that kind of construction. We've got to build at $195 a square foot to make the pro forma work. But he's going to go back to the design team and he's going to say, okay, you cannot do high rise or mid rise, which is going to cost $225, $250 a square foot. You have to do low rise wood frame construction because we got to bring this in for $195 a foot. Then the design team switches gears. They now know they can't come up with concept plans that down the road they were going. And they're now being told what road to go down in terms of a building type that can meet the budget, the hard cost budget. And then as we go through, we've got our concept plan now, we've got our schematics, we're now going into design development, which is where we get into the real detail work, the mechanical, electrical, plumbing, structural, all goes in. That gets us to about 60% complete. And then when we got our construction documents, our actual CDs, what they call the working drawings or the blueprints, they used to be called, we're at about 90%. And that's probably as high as you're going to get on the certainty scale, because there are always little changes that get made as you go along. You run into little obstacles, roadblocks. You got to make little scope changes to adjust. And then once the building is built, and you have your as-built plans, now you know with 100% certainty that that's the design of your building. So usually simultaneous with construction risk, which is the cost side of the pro forma, you're also doing market risk management, which is the revenue side of the pro forma. And the way you do that is you can research the market, you can shop the market yourself, or you can commission a market study or an appraisal expert to do it for you. When we were just getting started back in 1980, we shopped our own competitive market area. When we started in Hoboken, we decided that the market area we wanted to start our business in was a 5-minute walk to the Hoboken PATH station. So we walked 5 minutes up Washington Street, which is north. We walked 5 minutes west, northwest, and then 5 minutes straight west. Draw a curved line, and that was the area that we started our business in. And we spent 10 years in that market area. So the definition of a competitive market area is what market area are the people that are thinking about buying or renting your building? Where else are they going to go? What are they going to shop you against? In Jersey City, well, when we started, Jersey City there was nothing going on in Jersey City. So Hoboken was our market area, the competitive market area, because there wasn't much going on in the north and west part of town. The competitive market area was that 5-minute walk to the PATH train sub-market of Hoboken. And that's where we worked, and that's where everybody else that broke ground on a project or was planning on getting a project built, we would study their project because we want to know what's coming, what's the supply forecast. When you can understand what's coming in the market, you can identify whether there's any niches. For a while there in the mid-'80s to mid-'90s, everybody was doing 2-bedroom, 2-bath apartments, whether it was a rental or a condo. 2 bedrooms, 2 baths. Everybody was doing that. There was a lot of people, what they called mingles, people that are living together, but they're not a couple. 2 guys that are friends, 2 girls that are friends, a guy and a girl that are friends, and they're each renting the apartment together, but they want their own bedroom and their own bathroom. So most of the supply was 2-bed, 2-bath. We quickly discovered as we got into larger projects that there was a niche. Nobody was doing studios in 1s, and there were very little 3s and virtually no 4s. So we tried to start backfilling those niches by increasing the percentages of those types of units that most of our competitors were not building. And we did well on that. We were doing mostly condos through the 80s and 90s, and having a variety of product sizes and types meant that those units sold faster. The projects sold out faster because they're just more for different kinds of buyers to shop and look at. Pre-sales, when you're in a for-sale environment, are a great way to hedge market risk. When we did our first big building, which was in 1984, we did a 100-unit building called the Jefferson Trust Building on New York Street in Jersey City, which went along with the restoration of the Jefferson Trust Bank building, which was on the corner of First and Clinton. Our bank, we had been doing, I think the project we did right before that was a 25-unit project on 2nd and Bloomfield in Hoboken. And the bank said, wait a minute, you want to do a 100-unit building? You've only ever done a 20-unit building. How can you do a 100-unit building? So we basically said, look, we've got a professional construction manager. They met the guy. They knew the guy. They got comfortable that the guy could build the building. They were not comfortable with the fact, are we going to be able to sell 100 condominiums in Hoboken in 1984, 85, when there was little or no condo product coming to market. So they had no comparables to look at. So we said, okay, well, we're so confident we will sell 50 units before you have to close the construction loan. So we offered them a 50% pre-sale. And by selling the 50 units at the end of the project, there was virtually all the money we needed to pay the bank back. So that really reduced their concern, and that eliminated market risk for us too, because we wanted to make sure what we were designing was going to be something the market was going to want to buy. But we sold those 50 units in 3 months, and everybody was astounded that what we thought was going to happen happened. And they closed the loan, and we built the building, and it sold out, and great success. So pre-sales are a very good way to hedge market risk if you're in a sale environment, condo sale, townhouse sale. Different for rentals. When you do a rental, people aren't going to rent an apartment before the building is built. If you're doing condos and people believe that They can tie up that unit, get qualified for their mortgage, wait for 12 to 18 months till it's finished, and then close at the same price when probably the price on the last 50 units, speaking of Jefferson Trust, the price we sold the last 50 units was significantly higher than those 50 pre-sale units. So by the time those people closed, that condo they bought for $250,000 was now being resold for $300,000. It built in equity appreciation just by signing a pre-sale contract. Phasing projects is a great way to hedge market risk. So if you have a multi-phase project and you build phase one and everything sells out or rents up super fast, then you know you've got the right product and you stick with it for subsequent phases. If on the other hand, you thought condos were going to sell for $750 a square foot and you couldn't get anybody to offer anything over $500,000 for those condos, there's something wrong with your market research. But by having future phases coming, you get to adjust the market offering, and you can change things like maybe the units were too big. Maybe by reducing the square footage of the units, you can bring those average sale prices down to where the market wants to be. So the current phase informs you whether or not you need to make any adjustments on subsequent phases. And that's what a phased project gives you in terms of hedging market risk. Now, there may be some zoning implications to that. If you want to phase a project, you're going to have to do a subdivision. And sometimes subdivisions have their own issues, standards and setbacks and things. So obviously your zoning attorney is going to be working with your design team. And when you're talking about a phased project and creating a subdivision plan, you need to be aware whether or not the phasing in and of itself is going to cause implications that may devalue the overall project size.
We have a question in the chat.
Yep, go ahead.
The question asks, how much more would you pay for a property that is in an opportunity zone?
Good question. You know, an opportunity zone, the big benefit is the beginning benefit was that you got to save money on taxes you get to defer taxes on the amount of money you invested into the opportunity zone. That was only for the first 2 years. Now the benefit is when you invest in an opportunity zone after the first 2 years of the program, which I think started in 2019. Now what you get is you get an exit benefit. When you sell that project at the end of 10, you've held it for 10 years, and then you sell it, you pay no tax on the gain. No tax, no federal tax whatsoever. That's a huge benefit to investors that want to invest in opportunity zones. So the question is, what would you pay for it? Well, you have to do some math. And when we get into the metrics part of today's conversation, we're going to talk about some of the formulas that you can use that create metrics to see what the value of that tax break is going to be. It's called a present value analysis, and we're going to go through that in a little bit. And then you'll use that analysis with reasonable assumptions in terms of discount rates. You'll use that analysis to inform how much additional value there is at that 10-year sale price, and how does that relate into your current metrics, which is your internal rate of return, your return on equity, your leverage yield, your unleveraged yield. All those things we're going to go through later this morning. But that's basically how I can't tell you that I'll pay 20% more for a piece of dirt in an opportunity zone, because there are just too many other variables that have to go into the model in terms of, you know, what is the real benefit? What's the benefit after tax? So long answer to a good question. The short answer is you're going to run some equations and you're going to come up with some reasonable inputs to those equations. And that's going to tell you how much more value there is. And then you can assign a certain amount of that value to paying more for the land. So I think we went through this sheet, and we're going to talk about some valuation metrics. So valuation is about prediction. When you're doing a redevelopment or a development project, you're trying to predict what that property is going to be worth upon completion. You're going to want to know what your land value is going in, and what you said, what we call the as approved land value, meaning you got your zoning done, you know what your environmental costs are going to be, you have a pretty good handle on what your construction costs are and your market revenues are. And all those will domino into the initial metric, which is what's the value of the land now that you've reduced or eliminated all those risks. And then the as-built environment of the as-built valuation, which is what's it going to be worth when it's finished and stabilized. So stabilization is an important word in valuation. In a rental scenario, stabilization means you've opened the building and you've operated it at full occupancy for 1 year. And the reason that's important is after 1 year, you know what your rents were, you know what your vacancy rate was, you know what all your operating costs were. They're all actual results. And those are the best ways to value a building, is based on actual results as opposed to projected or estimated results. So the true value of a building is stabilized value. And that's the value that the bank will use. If it's a rental building, that's the value that the bank will use to determine how much money they're going to give you on your permanent long-term mortgage. On a for sale scenario, the valuation is a little more straightforward, a little less complex, because it's basically, you know, how many units have you sold pre-sale, if any, and then how many did you sell at the back end and at what price per square foot. That gives you your valuation. There's generally not really a valuation issue between the developer and his bank once he's bought the initial market study that projects what the value is going to be. Because at the end of the day, when the building's built, you're going to sell it all out as condos. And every one of those condo buyers is going to go get their own mortgage. And their bank is going to want to see that the value that they're paying for that condo is fair market value. So they're going to do an analysis of what are competitive condo projects selling out for in your competitive market area. And as long as your sale price for your buyer is within those ranges, those reasonable ranges, they're going to get their mortgage. So the three ways of doing appraisals are replacement costs, sales comps, and income cap method. So we'll just go through those just quickly. Don't need to do a super deep dive. Replacement cost is pretty much self-explanatory. So the appraiser is going to say, if this building got burned to the ground, what would it cost me to replace it? And that's going to give you a certain value. The second way is the sales comp method. Well, what did other buildings sell for? If it's condos, what did condos in your market sell for? If it's a rental building, what kind of cap rates have rental buildings sold for in your market area? I'm going to talk about cap rates in a little while. That's a big piece of valuation of income producing properties, cap rates. We'll get into that in a bit. So the sales comp is good when you have sales comps. When we started in Hoboken in 1980, we did our first 4-unit brownstone, converted to 4 condos. You know, it was a one-family brownstone. We bought it for $20,000 in 1980. We gutted it and put in 1 condo on each floor. So we converted it to a 4-unit condo. Well, there were no other condos in town at that point. We did the first one. So there was no sales comps. But fortunately, we had pre-sales. We had 2 pre-sales out of the 4 units, and that established market value. Income capitalization method. So this is the one for rental properties. Anytime you're going to rent a property, you use the income capitalization method. And it generates income, and the income stream is measured using a cap rate. And we'll explain how that happens in a second. But what it allows you to do, the income cap rate method allows you to convert an income stream into a single value, which is known as the cap rate. The result of this process gives you a present value estimate, which is the amount the purchaser investor would pay as of the valuation date for the right to receive those forecasted incomes over the period specified. So it's directly related to cash flow. And here's how it works. So you take your income and you divide that by your cap rate. So the income of the building is the stabilized income. And if it's a building, it could be anything that gives you income. The capitalization rate is what is the rate, what's the value that appraisers and market study experts are assigning to that income stream. So if you bought a CD, let's say, a certificate of deposit, or let's say it's a building that was yielding $4,000 a year, and if cap rates were at 4%, then the value of that $4,000 a year income at a 4 cap is $100,000. You're taking the income, you're dividing it by a cap rate, and you're coming up with the value. So all of those risk management processes domino into financial risk. And this is what I call the uber risk. This is the overarching risk of all projects, is the financial risk. Because if you can't attract the capital providers, because the financial risk at the end of the day, when they studied all your other risk management tracks and summaries, and they still think it's too risky, they're not going to invest. And if they do decide to invest, it's going to cost you more, because they're going to add a risk premium, a higher risk premium based on their perception of how risky the deal is. So if you can sit down and go through your entitlement risk, your environmental risk, your construction risk, your market risk, and they can see that you've done everything you can do, you've eliminated them, or you've significantly quantified and reduced those risks to the point where they believe the assumptions in your pro forma are accurate and documented and certified by third-party experts, and then they see the return at the bottom of your pro forma, and they believe that return is accurately predicted, they're going to invest, and they're going to invest, and it's going to cost you, the developer, less of the profit to give them. So the capital stack is what we refer to. How do I finance the total project cost? And it's made up of layers. And each layer, starting at the top of the stack and heading to the bottom of the stack, gets progressively less and less risky, because at the bottom of the capital stack is your bank. And the reason bank money is so cheap, you can borrow bank construction money right now for 4 or 5%, and they'll put up 75% of your total capital stack, your total cost of the project, which is your land cost, your soft costs, and your hard costs. That's your total project cost. So they'll do 75% of that, and at a super cheap rate, because they know that if the project goes bad, the profit's got to disappear. That's usually 30%. Your sponsor equity loses all his money. Your investors lose all their money. If you use a mezzanine lender, which we'll talk about in a minute, what a mezzanine debt instrument is, that's another 15%. So literally 15, 9, 1, and 30, you're looking at 25, 55% you have to be wrong on your pro forma before the bank loses a dime. That's why it's so cheap. The mezz guy is more expensive because he's going higher up the capital stack. Now you're only going to blow through the profit, sponsor equity, and the investor equity before the mezz guy takes a hit. And then likewise, the investor, who's up at the 90 to 99% of the capital stack layer, he's only got the sponsors 1% ahead of him as a loss deductible in addition to that profit projection. So the investor is going to be very, very expensive because he's way up top of the capital stack where it's the riskiest. Other ways we hedge financial risk is we invest in prime locations. When we started thinking about forming our real estate development career back in 1977, I met my partner in 72, Danny Gans, and we were going back. We graduated in 76. We were going back to school for a reunion in 77. We decided we were going to start a real estate development company, and we were going to take 3 years before we bought our first building, which would have given us both times to get our master's degrees done. I did an MBA in finance. He did a master's degree in interior design and construction management, and that was going to take us till 78. Meanwhile, we had a mentor, a good buddy of mine's dad was a real estate developer who had retired, and he started mentoring us while we were going around and doing road trips every weekend from 1977 to 1980. We did a road trip to some market, discovered Hoboken in the late 70s, discovered the first building in the very late 70s, and closed on it in 1980. And that was Hoboken's first condo conversion project. So by investing in a prime location, and we thought Hoboken was prime. We had a number of criteria to define what's our starting market, what's going to be the best starting market. Well, here's a couple of things. Access to a major employment anchor. Well, Hoboken, you can't get any closer to Manhattan, which is a major employment anchor, unless you're in Manhattan. We've got the PATH trains that take you right through to anywhere from downtown up to Midtown. We've got ferries, north end of the town. You got the Lincoln Tunnel, south end of the town. You got the Holland Tunnel. There's probably no place in the world easier to get into a big city like Manhattan than Hoboken. Not to mention the views and the fact that back then, Jersey had a lot lower taxes than Manhattan. Now they're still lower, but not as much. And then it also had a university, Stevens Institute of Technology, and it had a teaching hospital. St. Mary's Hospital was a teaching hospital. So those are major employment anchors too. So mass transit, anchors, employment anchors like universities and hospitals, access to jobs, and of course the cost of entry. You know, like I said, we bought our first brownstone for $20,000. In the late 70s, people were still, longtime Hoboken residents were still trying to get out of town. But there was nobody that wanted to buy their buildings until guys like us showed up. And that continued. They continued to exit the town and sell their buildings for what us developers thought were really good prices. They probably thought they were really good too, because, you know, probably for the last 10 years, they were trying to sell their property with no buyers. So we were able to continue to purchase property all the way through the 80s and into the 90s at very, very good prices, because the old timers didn't understand the market dynamics, didn't understand the renaissance that Hoboken was just getting started with, and missed out on a lot of value. I mean, I spoke to people that sold out in the 80s, and they said, geez, I wish I'd have waited 20 years. I would have got, you know, multiple times more for my brownstone if I had just waited a little longer. But they just didn't have the understanding of the market dynamics. It's like, you know, when you can't see the forest for the trees type of thing. So we considered Hoboken a very prime location, and that's totally been justified by the experience of the Hoboken market over these last 40 years. I mean, even after Hurricane Sandy, when every street west of Bloomfield, maybe Garden Street didn't get hit too bad, but every street west of Garden Street was under 4 feet of water. And all those first floor apartments and the subgrade apartments, there was a lot of buildings that had a basement apartment. They got flooded out. Before you knew it, all the gutting that had to be done and all the flood damage was all piled up down the streets, and there was trucks carting that stuff away for weeks and weeks and weeks. And everybody said, oh no, what's going to happen to the market? Well, guess what? All the damaged apartments got renovated. The minute they were done, they leased up, and the rents never tailed off at all. So that's what a prime market is. That's how a prime location is going to hold value. And then we give preferred returns to our investors. That's how we hedge financial risk to the investors. So that the preferred return is like an interest rate that accrues on the investor's capital account, which is the amount of money they put into the deal goes into their capital account. And we give them a preferred return on that, which means that interest rate accrues all the way to the end of the project. When it's time to pay them off, they get their principal back, they get their preferred return, and then we split profits. We get the same preferred return on our investor too, as the sponsor, as the developer. We earn the same preferred return on our money. And you can negotiate whether you get your money back pari passu, meaning in this case, if I'm putting up 1% of the 10% equity requirement, my investor's putting up 9%. That's a 90-10 sponsor investor equity split. And so you could repay the sponsor, the developer, and the investor at a 90-10 rate, sharing in the money in first dollar back, or you could negotiate that the investor gets all his money back and his preferred return, then you, the developer, get your money back and your preferred return. These are all different ways you can negotiate with an investor and try to get the investor to perceive a lower risk premium. A lower risk perception equals a lower risk premium. The other way you can do it, instead of a straight 90-10, in this case, in this example, it would be a straight 90-10 split of profits. You could also do promotes and waterfalls. So a waterfall, think of it as a stairwell going up. You go up the step, you have a tread where your foot goes, then the riser that takes you up to the next step. Well, the tread is the hurdle rate. Like, what do I got to get you over before I then get promoted to a larger profit share? So let's say in the case of a 90-10 initial equity ratio, we put that through a waterfall. And what we might say, what we might negotiate with our developer is, okay, we'll go 90-10 on all revenue up to the point where you've earned your 10% return, your 10% prep. Then it goes to 80-20. So you get to call it a 12% IRR. Then it goes to a 50-50 when you're at a 15% IRR. And then it goes 75 to the developer, 25 to the investor, till you're at an 18 IRR. So what you're doing is you're promoting the developer's share of the profit as the investor reaches certain hurdle rates. So it gives the investor downside protection, because at the lower return levels, he's making the lion's share of the cash being distributed. But then as the deal becomes more and more profitable to the investor, he rewards the developer for that performance by promoting the developer to a larger and larger share of subsequent profits. So two ways to do profit sharing with the investor. The developer can just do a straight split. I'll put up 10%, you put up 90% of the equity, and we split everything 90-10. Or we can go into a waterfall where the developer's expertise at giving higher and higher returns to his investor gets rewarded by the investor by promoting the developer to getting larger and larger shares of the profits as the developer's return goes up. So here's a budget that gives you the assumptions that are going to be used on a pro forma. And you start off with building assumptions, what size building, what's the net, what's the gross, revenue assumptions. By the way, just real quick on net and gross square footage. So building an apartment building, there's an efficiency ratio, which is the ratio between the gross square footage and the net square footage. The gross square footage includes all the common areas, the hallways, the stairwells, the elevators, the amenity spaces. That's all gross square feet. What's the total size of the building with the apartments and everything else that has to go into that building to make it usable? That's the gross square feet. And you multiply your construction cost times the gross square feet. And then there's an efficiency ratio. We try to hit 15% of the gross square feet to be common area, and then the net square feet is 85%. So in this case, if the gross square foot per unit, which includes all the common areas, is 1,000 square feet, then it's 15% efficiency ratio. The net square feet per unit is 850 square feet per apartment. That's the average usable square footage in your apartment. So your revenue model is driven by the net square feet. Your cost model is driven by gross square feet, because you got to build 100% of the square footage, but you only get to rent 85% of the square footage. Or if it's a condo, you only get to sell 85% of the square footage. So your revenue number is based on net square foot per unit. Your construction cost is gross square foot. And then you plug those assumptions in to your number of units and number of square feet, and you can generate your revenue assumptions. You can generate your cost assumptions. In this case, we're looking at a building that costs $230 a square foot hard cost, and we're estimating soft cost is going to be 30% of hard costs, which would be another $69 a foot. You drop that down to the budget assumption. You've now got your capital stack requirements. You've got your land costs, your hard costs, your soft costs. This is a $54,900,000 building in this example. And then you generate your profit based on, this is a condo project where you're selling at a sale price per net square foot of $1,000 a square foot. So in this case, you got a building that brings in 82 million of revenue, costs 54, almost 55 million of cost. You're looking at a $27 million profit. And that gets shared between you and your investors. So you've got 1% the sponsor, the developer's putting up, the investor's putting up 9%. There's a mezz loan of 15, and there's bank debt of 75. That gives you your capital stack at each of the layers of the capital stack. Now, let me just take a minute to talk about mezzanine debt. Mezzanine debt is a product that's available. Some people call it hard money loans. It typically comes with a much higher interest rate than the bank. If the bank's at 4%, a mezz lender may be at 10% or higher. But it goes way further up the capital stack. By having that mezz layer there on top of the bank, I'm at 90% of my capital stack. I only need another 10%. And the less money you need from the investor, the more profit's going to be left at the end of the day, because the mezz lender gets no percent of the profit. All he gets is a much higher interest rate than the bank, none of the profit. So when do you use mezz debt? In my way of thinking, you use mezz debt when you think the project is going to be very, very profitable, that it's going to be so profitable that it's better to pay that mezz guy a 10% interest rate than to have to raise that same amount of money from an investor who's going to want a preferred return, probably of 10%, plus a hefty slug of the profits. So if you think it's a highly profitable project, I load up on mezzanine debt. Mezzanine debt also is non-recourse typically, which means you don't have to personally guarantee it, and it's not secured. It doesn't have a mortgage on the property like the bank always has a first mortgage. So it's unsecured and it's non-recourse, which is a lot like equity, but it's a loan that only carries an interest rate, no profit participation, which means it's really debt. So it works like equity because it goes higher up the capital stack, but it's not, it's debt. So that's what mezzanine financing is all about, filling in the higher levels of the capital stack above where the bank is to be able to reduce the amount of investor capital that you need to get. Now, if you have uncertainty about the profitability of the project and you'd rather have more investor capital, because investors are going to ride the profits. If there's a lot of profits, they're going to get a big slug. And if there's not much profit or no profit, they're going to get nothing. Unlike a mezz lender is going to get his interest, and he's going to get all of his interest to the extent there is all that interest. And if there's not enough to pay the mezz guy all the interest, you're not personally obligated, but guess what? Your investor and you are making no money. So that takes us through there. Here's a diagram that talks a little bit about risk reward. So zero risk T-bills, bottom left corner at the bottom there, maybe up to 2.5, close to 3%. Bank debt, anywhere from 4 to maybe 8%. Mezz loans in the mid-teens, and then equity investors are going to be looking for 20%, north of 20% returns on their money. Capital stack pricing, here's what typical bank loans cost, what mezz loans cost, what you have to pay your investor, and what your sponsor earns when you're all done. I'm going to go quicker through this. By the way, Venetra said that we're going to post this PowerPoint. After we're done today, I'm going to get it down to her and she'll be posting this. And those of you that registered for the course can download a copy and you can get into some of these details. But I'm going to go a little bit faster over now because I want to get to the Q&A part. This is like in the next 5 or 10 minutes. So now there's a bunch of performance metrics and ratios and equations. There's 10 of them here that are the most widely used metrics to measure value. I think we're going to skip over these for now. In the interest of time, you've got your return on equity, you've got your leverage return on investment. Each one of these has its associated equation and what the inputs are to the equation: return on investment, NOI, cap rates, debt service coverage ratios, DSCRs. A lot of time a bank will say if it's a rental project that they'll give you a certain monthly payment, interest rate driven monthly payment on your loan. But once you're at your permanent loan and your building is stabilized, you have to maintain a certain debt service coverage ratio, which means the income has to be somewhere between 120 and 130% of the mortgage payment. That's how the bank hedges its bet that you're always going to be able to pay the mortgage. Operating efficiency ratios, gross rent multipliers. Most of you probably heard of these things, but maybe you don't know exactly what the formulas are. And then there's an example of each formula, unleveraged ratios, break-even ratios. Then you get into more advanced analysis. This goes to one of the questions somebody asked about how much more would you pay if you're in an opportunity zone? Well, you would do a present value. This is a future value analysis, which says, you know, once you know what the investment is over a period of time, what's it going to be worth at the end of that period of time? And there's present value analysis. This is the one I would use to see whether or not I can pay more for land in an opportunity zone. I want to know what the present value is of holding it for 10 years and then selling it tax-free at the end of the 10th year. That's the PV analysis. Net PV, similar. IRR, also similar. This is a single number that says what a cash flow is over a period of time. You put some money out in year 1, you get money back in year 2 through 10. You sell the asset in year 11. Well, what did that turn? What was the internal rate of return? Well, what did I actually earn on my money throughout the duration of that investment? What's the average of the returns on all the money coming back divided by the money I put out in the beginning? And what's that IRR? Another metric that people use to have a single metric to compare one investment compared to other investments. That's the break, but we're not taking the break. And then there's a lot of folks on the line. Craig sent me the list of attendees a couple of days ago, and it looks like about half the folks that are attending today are public sector people, a lot of redevelopment agencies and folks like that. So I had put in some slides about that. You know, how do the state agencies can help? There's the brownfield reimbursement. There's the hazardous discharge site remediation fund. Those both have to do with brownfield redevelopment assistance. There were some green tech incentives back years ago. They disappeared for a while, but now there's some of those are back now. Now you've got PACE financing, you've got solar tax credits and such, wind tax credits. New Jersey Transit right-of-ways, they're not, I don't want to say they're easy to get a hold of, but you can get a hold of a right-of-way. Transit has a right-of-way that they used to run trains on. They're not using it anymore. We were successful at getting the rights to clean up those right-of-ways, landscape them, and use them as open space and rails to trails type plans. And the only thing Transit does is they reserve the right to go back at any time in the future that they want to put surface transportation back on those right-of-ways, then you have to give them back. New Jersey Redevelopment Authority has grant and loan programs. There's other municipal tools that can be given to developers to aid the development process, giving the developer time. If it's a municipally owned property, give the developer time to go through his risk process. It's going to make the certainty of execution better, and you may need to recalibrate your purchase price, but at least you'll know it's based on factual site investigation results. You can expedite approvals, you can give abatements and pilots, you can finance the land sale by taking back paper. You can finance infrastructure through redevelopment area development bonds. You could allow the parking garage to be used as a commercial garage, meaning the public could go in. So if it's near a train stop, like most of our garages are, we ask the town to be able to rent any spots that aren't used by the residents. We can rent those to commuters and neighbors, making the garage more of a commercial use as opposed to an accessory use where it's only available to the residents. That gives you two users. You know, your mass transit users come in and park there during the day. If a lot of the parking spots become vacant because the residents use their car to get to work, well, then you have the right to rent those unused spots during the day to commuters. And then the residents and the neighbors are in there at night and on the weekends. Gives you two customer bases to get that more profit out of that garage. Community amenities, we were able to tap into the Federal Highway Fund. A lot of rails to trails walkways are eligible for federal highway funding. Particularly, I mean, the main thing is if the walkway leads you to a transit hub, a mass transit hub, that automatically qualifies for federal highway funding. Talked about the BPU, alternative energies, and our Van Leer Chocolate Factory redevelopment in Jersey City. We designed two public parks on the 7-acre site And we were able to, that met our open space requirement, and the city wanted us to donate those parks to the Parks Department so they'd maintain them. So we got our open space requirement met. We put 2 beautiful parks, which are going to be used by the residents of the building as well as the neighbors. And the operating and maintenance costs were picked up by Jersey City instead of the building. That's a map of the Rail to Trail program we did from Van Leer over to the 2nd Street Light Rail Station. These next series of slides are all about structured seller financing. There are 11 different structures that you can employ, from a joint venture to seller financing to optioning property. And each one of these has a different assumption set, which is described in the narrative before the spreadsheet. So this would be a full joint venture. That's how that's described narratively. This is the results we generate. I'm using the same exact project for each one of these, and what would be the results to the property owner under each of these 11 different structures. You can follow through the spreadsheets and you can get to the bottom line and see how the seller's financial performance was under each of these different structures. So we describe it, use of mezz financing, and then we spreadsheet it. We describe it, here's a sale contract with seller providing a mezz loan, which is what we did at the Van Leer price. Spreadsheet, contracting with the seller to take a junior loan, like a second mortgage on the property, a little bit riskier than a first, but if the seller's confident, he may want to put some money back in at a second mortgage rate, which earns a higher interest rate than a first mortgage. Spreadsheet. Senior financing, you may get the seller to take back a first mortgage on the property to reduce the amount of cash you have to put up until you're ready to build. Once you're ready to build, the construction lender is going to come in. The construction lender is going to want a first mortgage. So at that point, you're going to pay the seller's first mortgage off. So essentially, he gave you a bridge loan. He let you put a little bit of money down, take title to the property. He carried a mortgage, made a little interest until you're ready to build, and then he gets paid in full. Spreadsheet for that. Options are a great way to control property without the obligation to close. The seller pays all the carry costs, and you can walk away at any point where you feel the deal is not significant enough money for you to raise the capital to do the deal. Phase takedowns, like an installment sale, that's obviously, we talked about the value of a phase takedown. You don't have to pay for all the land up front. You pay for each phase as you go to use it. Options are great. You can take an option to purchase the entire property. You can take an option to close on just portions of it. It can be an option at a fixed price. You can do an option at a formula price. I like formula pricing because it really is, I think it's the fairest way to deal with a landowner. A formula sale price contract basically says, okay, we're going to agree that the land value per approved residential unit, let's say it's either a condo or a rental building, residential building. Let's just say, for example, each unit is worth $50,000. You haven't gone in for zoning yet. You think you know how many units you can build. So you tell them, well, the site is entitled to 200 units at $50,000 a unit. That gives you a $10 million land price. But if we get more than 200 units, we're going to give you an additional $50,000 for each additional unit we get. And that's a formula price. Usually it has a minimum. And then for every unit above that minimum, they make more money. And that's fair. And that's a good incentive for a seller to work with a developer, particularly when the developer feels like there's an opportunity to get more zoning, more density. And then you've got a potential situation where the owner of the property wants to do, it's a brownfield site, he wants to do the remediation himself before he gives title over to you, and that's fine. You can structure a deal like that. And then while he's doing the remediation, you're going through all the other risk management tracks. So by the time he's done and the property's clean and he's ready to transfer title to you, you are ready to break ground. All cash, no contingencies, quick close. This is an instance where the value of the property is tremendous. The seller is inflexible. Everybody wants that property, and all you can do to get it is to just say, I'm ready to close in 2 weeks, all cash, no contingencies. Here's a big non-refundable deposit, and that's usually going to win you the day. And that is how we ended up with the Maxwell House deal, which was the last and largest deal we did in Hoboken before we moved into Jersey City. We started that deal in '99, and it's just finishing up the last block as we speak in Jersey City, in Hoboken on the Laurel Street. Another deal we did was the Van Leer Chocolate Factory. This was a good example of a sale price with a formula-based purchase price, with the seller providing mezz financing and ending up making a lot more by doing the formula price. We got a lot more units zoned than we thought we were going to, and he put some of the money that he made on those extra units into the project at the mezz layer at a 6% rate, which is a super cheap rate for mezz money. But he was comfortable doing that because he got his base minimum price, and he was basically just investing the bonus monies we got from those additional units we got zoned that we didn't know. We weren't sure we were going to get those up front. So this, you're looking at downtown Jersey City, Hoboken in the foreground, Manhattan across the river. Those two big yellow boxes was the site of the Van Leer Chocolate Factory. It's a 7-acre site on 2 parcels right across the street from each other. We then contracted for the city chemical site, which is the one in beige, and 3 of the 4 blocks that are outlined in red. And so one of the things you want to try to do when you're doing redevelopment at scale is you want to try to tie up and control as much property around your development as possible, so that as each development gets completed and the value of all property in the neighborhood goes up, you're realizing a lot of that value gain because you're owning a lot of the properties around that initial property. And as each subsequent parcel gets developed, all the values go up. So you want to capture as much of that value as you can. Just an aerial view of the various sites we had under control in that neighborhood. After demolition of the factory, getting ready to go in the ground, that's the site plan. That's phase 1 that was finished. Phase 2 is finished. Phase 3 is finished, and 4 is finished right now. And we're up to 5, 6, and 7, which are the last 3 phases of that project. The Maxwell House Coffee Factory was the one that I mentioned that was a just get in there and just pay the price in cash, no contingencies, no negotiating. You just have to have the property. And we basically made the guy an all cash offer, put up a lot of non-refundable deposit money, and closed within a matter of weeks. That's what it looked like when it was built back in '38. It was the largest coffee factory in the world. That's what it looked like when we bought it. 24-acre site between 10th and 12th Street, 1.1 million square feet of building under the roof. Massive buildings, as you can tell by the people standing around there. Initially, we wanted to do an adaptive reuse of the existing buildings. This shows that during demolition, we were not able to convince the town, the community, to do it. So we knocked everything down, we cleaned it all up. We were going to try to do an adaptive reuse because we love this anchor building, which was going to be in the middle of it. We came up with this concept plan, but unfortunately, the community did not support this. Some did, but the majority didn't, because as you can see, there's buildings on the waterfront, and the community really wanted a park on the waterfront. They want a continuous linear park up and down the entire waterfront of Hoboken. This being a major piece of that waterfront, they insisted on a waterfront park, which meant we had to switch to this plan, which was a total tear down of the property. We created 4 new city blocks with about 1.8 million square feet of apartments, 832 apartments, 250,000 feet of office and retail space, and parking for everybody. And then the entire waterfront was separated by Sinatra Drive and everything on the water side of Sinatra Park. The pier, the platform, the peninsula, it was all public. We donated it. It's called Maxwell Park. Donated it to the town with a 5th-year operating and maintenance subsidy. Here you can see demolition is complete in the top left corner. Block A and a part of Block B is built in the middle one. Block B is continuing to be built in the 3rd picture. There's Block A and Block B finished. There's a picture of one of the playgrounds on the park. We have an older kid playground and a tot lot on the park. And this is the final slide of the presentation, where this was the first 4th of July fireworks show. People are queuing up. It's sunset. That's Block A right behind us there. And people are now lining up in the park waiting for the sunset and the fireworks show. And this is really my favorite picture in 41 years of developing real estate. I love creating neighborhoods and communities and open space where people want to be. And this is probably the best example I've ever seen of anything we've ever built, proving people really do want to be there. So that's the end of today's presentation. We can open it up. Venetia, if there are any other questions, lob them at me. And if not, maybe we should just wait a minute or two and see if anybody else wants to post a question. And if not, I think we can call it a day.
Okay, yes, I do have one question here. It says, when have you walked away from a deal / project? And what triggered you to walk away after having making a significant investment in a project?
Yeah, I've got a pretty good track record of not walking away because I'm a good negotiator, and negotiation is really about finding compromises that makes all the parties either, equally happy or equally unhappy. But one in particular was really one that I regretted a lot. It was up in Massachusetts. It was a hospital site, very large piece of property with a derelict hospital that had been closed for 20 years. It was owned by the Archdiocese of Boston. And I got a pretty good deal to get site control from the Archdiocese. And they were happy. They understood it was going to take a couple of years for me to get through the risk management. Then I started working with the community. And initially, the politicians I was dealing with seemed very supportive. But as the concept plan got developed and we were working on meeting the politicians' expectations, they just kept piling on. They kept adding more and more costs to the project, and they kept requiring different kinds of product. Like they didn't want children. Generally, children are bad in politicians' minds because children create school capacity problems. And if they have to build more schools, they have to raise taxes. And if they raise taxes, they usually get voted out. So they really have a problem with schools. So this particular town started saying, well, we're only going to allow you to build so much market rate housing because we don't want to generate any school children, or not too many school children. And then you can do the rest of it as assisted living or senior housing. But meanwhile, there was senior housing communities that had been built in a lot of the adjacent towns. We didn't think there was enough market demand for the senior housing. And then on top of that, they originally said they were going to help with the sewage. Then they backed off on that. They said, no, you're going to have to build your own treatment plant. They said they had enough water. And then they said, well, we really don't have enough water. We're going to have to make you pay for more water. And eventually we got to the point where they just lobbed on so many costs that it tanked the pro forma. And we just said, look, there's just no way we can do this with all these conditions you keep coming up with. And we basically walked away. And that was a bad one. So I think the lesson there is to be very, very thorough with the town when you're in your early stage due diligence. When it comes to water availability, sewer availability, the town's willingness or unwillingness to give some property tax relief, whether or not they're willing to fund some of the infrastructure through their ability to issue bonds. You really need to get those discussions going early on and get something in writing from the town that they are willing to do X, Y, and Z to support the project, because it's too easy to, make nice up front and everybody's getting along great. And then when you're getting closer to being willing to submit your project to their planning board and get the actual approvals or sign a redeveloper agreement where you're actually negotiating what you're going to do and what the town's going to do to make the project a success. You don't want to wait too long for that because it gives everybody the opportunity to change their minds or not remember things or think of things they hadn't thought of earlier. So the earlier you can have those kinds of discussions, the better, and the less likely you're going to go through a whole long, extensive risk reduction process, risk management process, but end up with a pro forma that doesn't work. So the bottom line is you walk away when you can't make enough money to attract the capital you're going to need to build the building.
Okay. And we have one more question. It says, with the supply chain issue, inflation, and pandemic still lingering, which has caused increase in construction costs, how do you manage this risk?
Yeah, that's a really good question. I mean, lumber prices have gone up over 1,000% since the pandemic started. So wood frame construction has jumped astronomically. I mean, a wood frame building that used to cost $195 a square foot is probably going to cost somewhere around $210, $215 a square foot now, which is like a 10% increase. There's a couple of ways you can hedge it. You know, you can buy options, you can buy futures options on the market, on the commodities market. That's one way you can do it. Another way you can do it is build in a big contingency. You know, if you think prices are at, I happen to think lumber prices peaked and already they're starting to come down now. So if I was doing a pro forma, I would probably discount the lumber price. I would say if it's $1,000 a board foot bundle now, that by the time I'm ready to start buying wood in 12 months, when I have all my approvals and permits and I'm ready to start purchasing materials, maybe it's going to be down 10 or 20% by then. A lot of it is what we call swag, scientific wild ass guesses. You've really got to be, if you think the costs are going up, you better build in a lot of contingency. Where normally you'd have a 5% hard cost contingency. When you've got this commodity market uncertainty, you might want to make that contingency 10% or maybe even a little higher, because your contingency line item is really where you go when you have cost overruns. I mean, you can have all the cost overruns you want on all the individual line items, but as long as the contingency covers it, because that's already an anticipated cost in your budget. But if you blow through your contingency and now you've got cost overruns not covered by the contingency, you've got a problem. You're going to either have to do a capital call and bring in more money from your investors, or you're going to see if some of your vendors or contractors will hold off getting final payments until after you start gaining revenue. It gets very messy when you go over budget. And by over budget, I mean you blow through the contingency. So very difficult these days. The builders that have been building through the pandemic with lumber prices surging the way they had, the only real offset to that is the rental rates in a lot of markets, including downtown Jersey City, has gone up as much as costs have increased. So that gives you some comfort that at the end of the day, when the project's over, you're going to be fine. But that may not help you with being able to pay those lumber bills while you're building.
Okay, so that was our last question. If anyone else has any questions that they would just like to direct to Mr. Vallone after the webinar, please feel free to email those questions and I'll get them to him. And I'm going to go ahead and close it out. Mr. Vallone, if you're good.
I'm good. Thanks for all your help, Anisha. You made it very painless for a non-tech savvy guy like me.
All right, no problem. Okay, at this time, I would like to thank everyone for joining our webinar. We hope that you got some takeaways from this and that you will join us again. As previously mentioned, we do have a webinar coming up June 23rd. That's going to be talking about land zoning and zoning laws. So you can register for that one. The registration is up. And that is it. See you all soon.
See you all soon. Have a great weekend, everybody.
Bye-bye.
And Anisha.
Thank you, George. Okay.